It's another edition of the Trading Tips video newsletter, teaching you how to become a successful trader today. This video newsletter is brought to you by PortfolioCrafter.com.
Hello, and welcome to this edition of the TradingTips.com video newsletter.
In this episode, we'll be looking at VIX Options.
Buying stocks and calls let you make money in a bull market. Selling stocks short or buying puts lets you make money in a bear market.
The VIX, which is a measure of the market's volatility, can actually help you make money in a stable market, and buying or selling options on the VIX leverages this opportunity. Intrigued? Let's begin.
First, let's take a look at what the VIX is.
VIX is the symbol for the Chicago Board Options Exchange's Volatility Index. Whereas the beta coefficient measures the historical volatility, the VIX measures implied volatility of a wide range of options based on the S&P 500.
When investors think there is going to be volatility in the future, there is more action in near-term options. The VIX measures this activity. For this reason, the VIX is often called the investor fear gauge.
So what are some ways investors can use the VIX?
Well, simply being aware of the VIX can inform all stock trading decisions. While the VIX merely predicts future volatility and doesn't guarantee it, it has been the best predictor of near-term volatility known. Secondly, investors who want to bet on market volatility can buy the exchange-traded funds VXX for short-term volatility, VXZ for mid-term volatility, and TVIX for a double leverage play on short-term volatility.
All of the ETFs you mentioned give investors the opportunity to make money in a volatile market. But that's not as much of a challenge as making money in a stable market. Can you play the VIX that way?
Sure. For one, you could short the ETFs I mentioned. Or if you prefer, you can buy the XIV ETF, which is a daily inverse VIX fund. It goes up when the VIX goes down and vice versa.
It sounds like these ETFs would be very useful as hedges.
Absolutely. Not only does having some protection against volatility offer some insurance for your portfolio, having a protection against a lack of volatility could too. What's more, VIX ETFs offer instant diversification.
How is that?
Well, since diversification requires your holdings not trading in tandem, you'll be interested to know that the VIX normally trades in an inverse relationship to the S&P 500. Since 1990, it has moved opposite of the S&P 88% of the time. On average, the VIX has risen 16.8% on days which the S&P has fallen by 3% or more.
But what about VIX Options?
In 2006, the CBOE began offering options on the VIX. This lets traders leverage their bets on volatility, either for or against.
This can be used to hedge or diversify, but also to generate profits, even in sideways and stable markets.
That's right. Studies have shown that buying VIX calls is an even better way to hedge against a market crash than buying S&P 500 puts.
The VIX itself is extremely volatile. Total volatility for the VIX was 80% in 2005, compared to 10% for the S&P 500 and just 32% for Google, which made huge gains that year. Does this make buying options on the VIX especially risky?
The answer, surprisingly, is no. That's because the VIX itself, unlike stocks, cannot fall to zero. Its upper range is also limited. So while there is massive volatility, it always falls within a range. In this way, the VIX is safer than equity options.
VIX options also have extraordinary liquidity. Getting in and out of them is easy, and they have tight bid-ask spreads.
In fact, just a little over a month after VIX options were launched on February 26, 2006, they set a new single-day record for trading volume. As of February 2012, the average daily volume of VIX contracts was around 10,000.
There are advanced ways in which you can use VIX options too. Buying bull call spreads and selling bull put spreads can make you money when volatility rises. Buying bear call spreads and selling bear put spreads can make you money when volatility wanes.
Some traders pay no attention to anything but the VIX, wait for it to bottom out and then make a bullish play, then wait for it to reach its peak and make a bearish play.
In conclusion, the VIX is a measure of implied future volatility. You can play it by buying or selling ETFs that track it, including the XIV fund, which trades inversely to the VIX.
You can also buy or sell call options and put options, as well as option spreads, to try to capitalize off future volatility or a lack thereof, or to hedge or diversify your portfolio.
The options are virtually limitless, but the VIX itself trades within a limited scale. This actually makes the ultra-volatile VIX more stable in some ways than regular stocks.
It's the best of both worlds. You get a volatile security that can be traded in a wide variety of ways, but can never go bust or through the roof. Liquidity is high and the market is deep. There are many ways to trade the VIX for a wide variety of purposes. And we hope that after watching this episode, you'll be able to add VIX strategies to your trading arsenal.
We hope you've enjoyed this TradingTips.com video newsletter.
Thanks for watching and good trading.
This video newsletter has been brought to you by Portfolio Crafter. Manny Backus designed Portfolio Crafter to be one of the easiest trading systems available on the web today. But don't take our word for it. Visit www.portfoliocrafter.com and access the free special report. It will show you how you can place profit-rich stock trades in just 15 minutes a week. Read the free report, and you'll understand how the easy money's made in the markets. To access the free report, visit portfoliocrafter.com. Portfolio Crafter, another market-beating investment service from WealthPire. Take control of your financial destiny. View more Trading Tips videos. Visit tradingtips.com. Sign up for our free video newsletters and become a successful trader today.